And that leads me to, the current environment. You and I aren't COVID experts. We're not health experts. We would never try to forecast anything with the progress of any vaccine. But we've been in this business over 20 years, you and I, and we've seen a lot of different things, both at the individual and institutional level. One of the things you always see, it's guaranteed anytime there's an uncertainty in markets, there's distress, is a pitch for investment strategies that may not always be in investors' best interest. And I think the key term there you just highlighted a little bit was understanding and making sure that you get compensated for risk. So given a lot of the uncertainties in today's markets and all the different investment strategies available out there to investors, what are some of the ways that, and you may have mentioned this already a little bit, what are some of the ways that investors can really understand and ensure that they get properly compensated for taking the right kinds of risk in this environment?
Right. Well, the fundamental one in my view is having a financial plan and finding the right balance between stocks and bonds. And then once you have that balance, again, talk to an advisor and see for your situation, for your circumstances, what type of bonds you might want to own, because I just showed you that you can get paid anywhere from 0.7 to 8.5%. So you got to make some decisions there. So to me, there are decisions that we make starting with the stocks and bonds. Now within stocks, when it comes to risks, there are two types of risks that investors should consider. The first one, and I'm going to get a little technical, but I'll explain. It's quite fundamental. The first type of risk is that it's a risk that is not incurred by an entire market or entire group of stock, but stock type of risk. So something might happen with a company, like you heard wire fraud or whatever, or wire card, whatever the fraud was there. You have other situations like we've had in the past with Enron or any one company, like, have Exxon Valdez spill, whatever. I mean, there are plenty of examples like that. And some of them are industry specific, like you have oil that's running through this big downturn right now. So in that respect, the way that I would encourage investors to think is that you basically have two different strategies that you can employ, and you have to understand the risks associated with each. So the first strategy as an investor is to say, if this square is the entire stock market, what I like to do is select a handful of stocks and cherry pick what I think are the best investments out there. Maybe it's Zoom, the technology of the future. Maybe it's Amazon because it's taken over the world, whatever the case might be. And to really say, I'm going to concentrate a large portion of my money into these investments. And to me, there's certainly a benefit to this, because if you pick the right ones, it can absolutely shoot the lights out and you can make a lot of money out of it. There's no doubt in my mind that you can do this. And plenty of people have made tons of money by making concentrated picks. And quite often individual business owners, that's how they make money. They concentrate a lot in the equity of their own business. And that's sometimes what enables them to actually gain financial independence. So I think the concentration has been very appealing to a lot of people. And if you concentrate in private markets, there's risk there, but at least you're bringing to the table your own knowledge, your own skills. The thing that I warn people is that the risk in this strategy is that the more you concentrate, the more you can either make a lot of money, or at the very bad scenario, you can lose it all depending on how concentrated you are. So the range of what can happen with somebody's money is quite wide when you place these concentrated bets. And then to me, this is what I call the unsystematic risk, because it's a company-specific risk. Could be a very company-specific benefit if it really takes off. But to me, this way of investing in many ways creates unnecessary risk. Its risk can be mitigated through diversification, because in the way that academics have suggested, and the way that that Dimensional has been considering investing, these companies might be fine to hold. So they're not really, nothing against them. It's just that what we want to do is not examine and try to understand these companies by themselves, but rather put them alongside many other companies in a way that diversifies the portfolio, such that not any one investment would ever significantly, materially impact the portfolio. And in this respect, I think in a global equity fund, for example, you can have upwards of 12,000 different companies in 40 different countries, which basically means that it's very unlikely that any one of them would have a significant, meaningful impact in your portfolio. And what you're doing by doing this, you enter a different type of risk, which is called systematic risk. So you've kind of taken away the company specific risk, but now you're really looking at risks that might really hit a bunch of companies at once. And that's, for example, what we're going through the pandemic right now, rather than any company specific. So at least you've moved away from that, because not any one company would have a meaningful impact on the portfolio. And in that respect, what you do is you, in a way, put some boundaries around the range of what can happen with your money. In this case, if you own 12,000 companies, it's highly unlikely that all of them will disappear all at the same time for you to lose all your money. But on the other hand, because you're not as concentrated, there's not going to be a wonder company that really shoots the light out and changes your wealth status. So to me, it's just putting some range and narrowing the range of what can happen with your money, but you still actually have, upside potential. It's just much more about the risk. Is it a company specific risk, or are you looking more at a market broad risk? And to us, if you can eliminate a risk, why take it there?
Yeah, that's a really good point, because I think, you hear, and we know from some of the science, which is for a different discussion, but often there's a lot of stocks that don't ever make money or don't ever go up, right, historically. But there's a lot of stocks that go up as well, and sometimes it's a smaller number. So it's good to diversify, like you said, and eliminate that risk. And I think right now you're seeing some of that and some of the speculation